Hello CFA candidates. Welcome to this segment on the pricing and valuation of interest rate swaps. Hope this video could help you to save time and energy. Let us begin. The most common that you'll see in this segment is a plain vanilla interest rate swap, meaning one side on this swap is paying a fixed rate of interest, and one side a floating one. So if I go in on the pay fixed side, I'm going to pay the fixed rate and receive the floating rate. If I'm on the pay floating side or the receive, then it's the opposite. Why is it called a swap? Well, we are differentiating this agreement from FI we looked at in an earlier segment. When we looked at going long on an FI, we say we pay fixed and receive floating. The difference with an FI that happens just once. When it's a swap, this pay fixed and receive floating is going to repeat several times. We could have an annual swap that lasts 10 years. That will mean every year we'll pay fixed and receive floating for 10 years. What we're trying to do, as I say, is pricing the swap rate. How? Well, here's the key principle that we use at the inception of the swap. As with every other derivative we've priced so far, we try and set it to zero value. This principle is again just the principle of having zero value at initiation. We set it up so the present value of the fixed payments is equal to the present value of the floating payments. And as it turns out, with a little bit of kind of replication using the idea of bonds, we can try and work out what the fixed rate needs to be. Going forward, it will pick up value. So once we've priced it, we can go on and see what the value would be later in the life of the swap. Examples before we gonna go anywhere. Let's introduce you to the idea of discount factors. These are here to make your life in the world of swaps easier, and quite often the question will give you the discount factors, not even require you to calculate them. But you absolutely should know how to, and there is a chance you might need to on the date. So example we're given is a 1-year quarterly swap. What does that mean? Well, they'll be payments after 90, 180, 270 and 360 days. Based on these LIBOR. Now not the big news, just like FRA. As they are going to be based of LIBOR, which means we're looking at simple 360-day rates quoted annually. So even though we are given the 90-day LIBOR as 3%, that 3% is quoted annually. So as always with the LIBOR, we have to time a portion before we can do anything. So let's do it that first one, that 90-day LIBOR is 3%. We'd say, okay, that's quoted annually before I use it. So we time a portion of 3% with our 90/360, that will give us 0.75%. Now you take your cash flow and you divide it by 1.0075. All we're going to do. The 1 divided by 1.0075 is called a discount factor, which is 0.99256. So we can multiply by that discount factor rather than dividing by 1.0075. So that's what your discount factor looks like. It's 1 plus the LIBOR time portion. You could do the same for the 180. Take your 3.5% timer portion, 1 divided by 1 plus the calculated rate. That gives you 0.98280. And so on. Do it again for the 270 and again for the 360. The point is, with just being very mechanical here about the process. The 1-year rate, the 360 rate, is clearly the one you don't need to time portion. And what you have is for discount factors numbers that you can multiply a cash flow by to get its present value. That's all we're doing. It's quicker than having to divide by 1 plus the rate all the time. Note the decimal places. This is pretty much the only place in the syllabus where you would go to 5 decimal places. The guidance always is whatever they give you in the question. Give them back, so if they're giving me 5 decimal places for a discount factor, I'm going to use 5 decimal places. So make sure you take a bit of time to get on top of those calcs. How do we then use them? Well, like this, you work out the discount factor corresponding to every single settlement date. And then to work out what we're calling here, the swap fixed rate. You use this simple formula. You take 1 minus the last, that is, the final discount factor. So in my quarterly annual swap, it would be that 360-day. Divided by the sum of all of those discount factors. That would give you the swap fixed rate. For the settlement term, so if it's a quarterly swap, that would give you the fixed rate for the quarter. We always want to quote it annually. So you would then multiply it by the settlement periods per year. In this case. Now I know it looks like that formula comes out of absolutely nowhere. We actually get that by replicating the swap using bonds. We pretend we've got a fixed rate bond and a floating rate bond, and we try and equate the two values. Because we said the principal was the present value. The fixed payments should equal the present value of the floating. And the good news is we know at initiation what the present value of floating rate bond would be. It would be par at any reset date. The value of a floating rate bond is paragraph. So what we try and do is work out the coupon we would need on a fixed rate bond to equate it to paragraph. Now you don't need that, but that's where it comes from. But what you need to do is just apply it. Let's do exactly that. Calculate the swap rate and the fixed payment on a 1-year quarterly settlement swap with a notional principal of $1 million. And look what they've done for you here, give you the rates and the discount factors. Make sure you can calculate them. We just did. As soon as I see this in the exam, if I need a swap rate, what I'm going to do is add up the sum of all those discount factors. I'm going to need a 1 minus the final. Divided by the sum of those discount factors, it's that simple to price a swap. If you can add together those four numbers, and then take 1 minus the last one divided by that total, you've priced to swap. It is very straightforward procedure. We need to quote it annually, so you multiply by 4 quarters and we have 4.4%. That is your swap fixed rate. So pricing swaps is pretty straightforward. Working out the quarterly payment. Well, we now know we have 4.4% as the swap fixed rate. But that's quoted on an annual basis. The quarterly payment. Well, we'll need to time a portion of that annual rate. So we're going to divide it by 4 to get back to the quarterly rate. Once you've done that, multiply it by your notional principal, which is $1 million. Multiplied by it's going to be 1.1% that will give you a quarterly payment of $11,032. If you're the pay fix side, you'll be paying $11,032 every quarter. That's it. We've calculated our payment. Now after that what we need to do is value. The good news. We're only going to be asked, as we said here, to come up and value this swap at a settlement date. That makes it considerably easier than it might be, so only at the settlement date. So in the land of swaps, we don't use the terms long and short. What we say is either you are the pay fixed or receive fixed. So if we're saying the value to the pair, we're saying the value to whoever is paying the fixed rate. What do we do? Well, let's break it down. On the top we have rather the new swap fixed rate. So what we're going to have to do is repricing. Work out what the fixed rate would be today if we signed up. Minus the old swap fixed rate. What we actually signed up to. So that I think is very logical. In my example that we just did, we'd signed up at 4.4%. Let's calculate what the rate would be today. Repricing now the difference between those two rates is going to give you your value gain or loss at each state. Downside, these are annual, so you need to time a portion. If I'm using annual rates, then it's a quarterly swap. We'd need to divide it by 4. That will give you how much gain or loss you've got at each settlement date. Now to turn into dollars, multiply it by the notional principal. Once you've done that, you've worked out the difference in dollars at each settlement date. But as always, when you're asked to value, you need to bring that back to present value. How well in the past we've always divided by 1 plus each of the LIBOR. Well, now we're in the world of swaps. We have the discount factors. So each difference for every settlement date, you multiply by the relevant discount factor. Difference at every date. Let's put it into practice. So consider the same swap, the one we just went through. We priced at 4.4%. 180 days have passed. So get your timeline out initially. This was a quarterly swap. So you had payments due at 90, 180, 270 and 360. That's what we were looking at. But 180 days have passed. We're getting closer to its end. So we are now. Here, that's our new T0. So what do we have left? Immediately after that 180-day settlement, we had this payment due after 270 days, now 180 days have passed. Making that due in 90 days, and we have this settlement. The one due in 360 days, now is due in 180. So I've got two remaining settlement dates, 90 and 180 days away. Once again, we've given you the right rates to use, which is nice in the exam. Expect to have a whole term structure there and have to pick out that 90 and 180-day rate to get the correct calculation. We're saying the LIBOR curve indicates the new swap fixed rate is 3.5%. So we haven't made you go on and reprice it. But you could do exactly as we did with our discount factor formula, but we've repriced it, it's 3.5%. Already you can start logic checking what your answer is going to be. We signed up at 4.4%. The new swap fix rate is 3.5%. We've agreed to be paying out 4%, and if we waited and signed up today, we'd be paying out only 3.5%. I would expect a negative value here. We've got the discount factors. I need those discount factors calls that will allow me to discount back my differences. So let's do it. Well, we were given the discount factors on that previous slide 0.99133 and 0.98280. So let's add those up. They come to 1.9741. Then let's look at the value. On the top, the new swap fixed rate. I waited and signed up today. I would be paying a fixed rate of 3.5%. As it is, I signed up originally to be paying out 4.4%. 0.035 minus 0.044. So I got the difference, which is 0.009%. That's what I'm losing out on every payment date. So I'm just going to fill that in. That is minus 0.09% on every payment. However, that's annual. Because we always quote swap fixed rates on an annual basis. So I must divide it by 4. Because this was a quarterly swap. Comparing what I was paying. Or what if I agreed to pay to what I'd have to pay now if I signed up? I am losing 0.9%. Divide that by 4 and that is 0.225% loss on every payment. I need to turn that into US dollars. How do I do that? I need the notional principal. So I am losing 0.225% on $1 million at every payment date. So I can turn that into a dollar amount. That would be at every payment date. $22.50 is what I'm losing on each payment date. We are losing $22.50 at both payment dates. So all you need to do is discount both of those back to today. That's all we're doing. Getting both back to T0. So you could do them separately if you wanted to use the LIBOR to do it. But the quickest way to do it, because we've been given the discount factors, is to say it's 2,250 times that one and 2,250 times another one. Quickest way just to add them together, which it's 2250. Multiplied by the sum of those discount factors. It gives you that 2,250 multiplied by 1.9741, which is 4,441 negative as we expected. I locked in 4.4%. It's dropped to 3.5% as I am paying that fixed rate I having negative value. So rates went down, fixed pair loses. Thank you for watching. Next video we will talk about pricing and valuation, forward commitments of currency swap. If you find this explanation helpful, please subscribe my channel.